In an article published in the Los Angeles Times, a non-profit organization that helps low-income individuals apply for personal financial assistance discussed some of the negative effects of using payday loans. The author, Christine Luciano, says that most payday lenders use high fees to cover up the poor lending practices that they engage in. The problem is that many consumers use these loans because they do not understand the terms and conditions, and therefore, they have trouble obtaining a loan with the same form of repayment and due date as a regular loan. As a result, their lenders raise the interest rate, the length of the loan, and the number of payments, which may damage their credit. The author describes a situation where a consumer borrowed a short-term loan with a high interest rate and expected to repay it at a much lower amount of time. However, once she hit the repayment schedule and the debt began to accumulate interest, she found that the rates on her credit card were much higher than the interest rate on the loan. When a consumer tries to get approved for a long-term loan with a high rate of interest, their credit score may suffer because of the large debts they accumulate. The lack of credit when a borrower is out of a job can also damage their credit rating. Even though there are no laws against payday lenders, if they abuse their customers' credit, they may be more likely to receive approval from the credit agencies, but it can be a huge disadvantage for consumers who seek a loan or credit cards because of a lack of employment. Although the author points out that this problem may affect the lower income level individuals who use payday loans, it is also a problem for those individuals who make six figures or more per year, and this affects the purchasing power of this group. Payday loans are usually available to help individuals with emergency situations, but the need for them is likely to grow as the economy improves. For those who cannot get approved for other loans, payday loans can provide the money that the borrower needs immediately. Consumers who use payday loans should use them carefully. Many payday lenders operate online, and many consumers are unaware of the differences between taking out a traditional loan and a payday loan. A person should always take the time to read over the terms and conditions that are posted on the payday loans and decide whether or not they want to take advantage of them. Some states, such as California, have stricter requirements for payday lenders and require that all loans be limited to a month's worth of bills, which limits the lender's ability to maximize the use of the loans. Although the use of payday loans can negatively affect your credit score, the dangers of not repaying a loan may be more damaging. Most people who use these loans rarely or never pay back their loan and therefore, do not have enough cash to deal with emergencies and will lose their jobs. If you have a bad credit history, you should consider applying for a new loan because, if you do not, you can damage your credit score with each missed payment. However, even if you do not have a good credit history, you can still use payday loans, as long as you keep up your repayment schedule. In a recent study, many consumers reported that their credit was less of a problem after they took a risk and applied for a payday loan. Also, if you are in need of additional funding, this type of loan may provide you with the extra money you need to overcome a financial challenge.